And good afternoon. Welcome into another episode of Market Talk. Happy Friday, April 22nd. Thanks for joining us and making us part of your day. Once again, I'm your host, Jesse Allen. Find us on our website, markettalkag.com. You can link to all of our social media streaming sources, our YouTube channel, our radio affiliates, and much, much more. It's all online at markettalkag.com. Well, we had a very interesting way to wrap up the trading week here this week. A lot of pressure in soybeans and bean meal today. Corn pulled lower with it as well. Wheat markets able to rally back mostly and trade a bit higher. And we saw bean oil higher as well. Got some news about palm oil being banned exporting out of Indonesia. So a lot of things to consider, a lot of things to take a look at. And that's not even getting to the livestock trade either. Let's discuss. Let's bring in our good friend Ted Seifried with Zaner Ag Hedge here this afternoon. Ted, good afternoon to you, sir. And yeah, very interesting day. Very weird way to wrap up the week in the trade.
Yeah, absolutely, Jesse. No rest for the wicked, right? Um, like you said, there was a fair amount of fundamental stuff going on there on Friday. However, I don't think we traded much of that. What we were trading on Friday, what we were planning on trading on Friday and did trade on Friday was really option expiration. And that's a money flow thing, right? And when you have markets that have been in extended rallies, a lot of times what you have happen is you have a bit of a sell-off there. Uh, Profit taking is part of it. I mean, we'll get into the dynamics of how that works, right? But that was really, I think, what defined the day on Friday. And it really makes you question, with an outside reversal day in soybeans, do you put a whole lot of weight on that technical chart formation that we put in there on Friday? Or was that just really a bear trap slash head fake? And that will be very interesting to see what happens on Monday, when I do think we'll actually trade some of the fundamental news we learned about on Friday. But when we talk about option expiration, there's two things that are at play there. One, you have your option buyers, which are usually your specs, but more often than not, your small speculators, right? And so these are guys that don't really want to take futures positions into or they don't want to turn their long calls into futures positions. Otherwise, they probably would have been in futures in the first place. Um, so when you have a little bit of pressure on the market to start the day, they say, "Oh, okay, my very sensitive call instruments now that they're day of expiration are losing value very quickly. Get me out, get me out, get me out." So they're selling out of their call options, right? And when they are getting rid of their call options, at the same time, you have whoever sold them that call option, who had bought a future to cover that short call that they had, getting out of their long futures position, which again creates more pressure on the market. And then overall, your big option sellers, they've been just watching strike prices fall. 1680, 1690, $17, 1710, 1720, 30, 40, 50, 60. 1760s were in play overnight and at the start of the day there on Friday. So they defend those positions. They figure, okay, we can sell into this futures market that's already under a little bit of pressure and get some of these short calls out of the way, let them expire worthless so we can keep our profits there. So you have a lot of potential sellers on a day like Friday when you have option expiration in a widely traded option month, which is May, more so for soybeans than for corn, but May is a fairly heavily volume traded option. Not like November beans or December corn necessarily, but it is one of the bigger ones. So again, I think option expiration was the main feature of what we had there on Friday. But also, let's go back to the export sales. Those had been rumored going back to Wednesday, and then we didn't see him Thursday morning. We did see him on Friday, and sort of, old cliche, buy the rumor, sell the fact, Jesse. I think that had something to do with it as well. In this particular circumstance, it kind of makes sense to me why we sell off when we see these big Chinese purchases, because when we do, we usually go a week or two without seeing another one, right? And so the market figures, okay, that sale's out of the way. We don't have China in hunting to buy. We don't have to keep these prices elevated. We're not going to see that big splashy sale again for a little while. So, it's sort of the export sale hangover, let's call it, right?
Mhm.
So you had that going on with option expiration. The fact of the matter is, I mean, we are selling big chunks of corn to China right now. We had big sales to Mexico, old crop beans to Mexico. Uh, by my calculations, we are running out of old crop beans, and although we're not seeing the big gaudy numbers that we had been seeing about a month ago, I mean, the fact that we're still selling old crop beans is just pretty wild, especially with how tight that balance sheet is getting. So we're not really rationing demand. To me, I didn't really see any big negative fundamental change in the market there on Friday to cause a big sell-off. But whenever you have elevated prices like we have in markets that have been in long-term bull markets on an option expiration day, a little bit of a downdraft correction, correct that RSI. These things happen. I'll be very curious to see if this outside reversal down date does trigger some more technical selling early next week. And we do have a target down at about 1660 there for July beans. So maybe we get into that level, but I think there's a lot of would-be buyers out there at those levels. So that'll be interesting. And then, like you mentioned, the soybean oil, which did close fairly positive on the day, yet well off of its highs. I mean, that is a big deal. We know that, with the Russian-Ukrainian situation, you took away the world's largest exporter of sunflower oil. Now you take the largest exporter of palm oil out of the mix. Oh boy, you have a veg oil situation that was already really very tight. You have an energy situation which is looking for any sort of alternatives, um, and then you limit the world's supply even further of that. I think that will have a lasting effect on the markets, more so than whatever technical damage we did there on Friday. And yeah, I still think the fundamentals are really rather bullish for corn and soybeans going in to at least the first half of the growing season. Now, all bets are off once we get to July 4th. If we're looking at really very good crops, that will sort of alleviate some of the situation and take some of the pressure off of whatever is left of the old crop stocks. But until that happens, a 181 national average yield is a lofty expectation for corn. A 51.5 national average yield is a maybe not as lofty, but a lofty expectation for soybeans, especially when you consider where all the extra acreage is coming from. And I think we got to have some weather premium built in there, especially since we're really having a hard time getting in and planting right now.
Well, not only getting it and planting, but I know we're ways out and there's still a lot of ingredients that need to come together. But the Climate Prediction Center coming out this week with a
Yeah.
pretty scary forecast for the plains in the Midwest, Missouri into Iowa for this summer. And I mean, there's no guarantee that forecast is going to come to fruition, but if it does, that's not going to be a very good thing for crops, especially in a year where things are so tight. Ted.
Yeah, I feel like we're doing a lot of cliches here today, Jesse, or at least I am. But I trust long-term forecasts about as far as I can throw them. However, I am going to say that with the drought setup that we have, although it's been alleviated a little bit in some areas, with that setup combined with the NOAA's longer term outlook, it's got to be kind of scary, especially when you really don't feel like we have enough corn acres. And again, the expectation of a 181 national average yield in these circumstances with late potential, later planting, or at least later than what we had kind of gotten used to aside from 2019. And what we've seen good results on, by the way. I mean, that earlier planting might have a lot to do with the upward trend in the yield curve. And if we're not able to do that, we're not seemingly able to do that this year, what's the effect that's going to have on national average yield? So, yeah, the weather premium, the concern, certainly you can't feel comfortable with that this is going to be, the crop that the USDA is currently expecting. I'd say it's an uphill battle to get there with input costs being what they are. And at the very least, Jesse, what we've done with the weather that we've had so far and the forecast that we have at the moment, for all the people that were saying, okay, that acreage intentions survey, a lot's changed. The corn prices versus soybean prices. Corn bean ratio is really asking for a big increase in corn acres. We're probably going to get back 1 million to 1.5 million acres of corn. By the way, I was never really in that camp, but you take that idea away from the market because weather is the number one determinant on whether we see acreage shift in one direction or the other. And at this point, Jesse, you got to start to worry that maybe you're going to see some of those corn acres actually go further into soybeans. I still contend that maybe we can see up to a 500,000 acre shift back towards corn, but you can't really expect much more than that. And even that starts to become a bit of a stretch.
Well, Ted, the wheat market today kind of diverged from quarter beans. Said, we're not going to go with beans. We're gonna do our own thing.
Mm-hmm.
What do you make of the wheat market here? Obviously, we have longer delays now in the northern plains with spring wheat, just with the snows up there.
Yep.
We have the drought in the hard red winter wheat belt.
Yep.
That crop is looking ugly.
Bad.
What's your thoughts with the wheat market?
Yeah, I mean, winter wheat crop conditions dropped last week. We know this is a problem. This is really not a very good crop. So there's reason to be worried about that. There's reason to have strength in the market, to have elevated prices. Spring wheat is the strength of the complex right now because of its own weather problems with getting planted. Um, but going back to the middle of February when Russia invaded the Ukraine, we had what we call a short squeeze in the wheat market. Whoever was short had to get out and had to get out in a hurry. And when you're limit up every day, that makes it very difficult to do. So that short squeeze, I believe we went to prices higher than what I thought we could fundamentally really justify. And now we've backed off that and we've kind of settled into this wide but steady trading range that we've been in for over a month now. So again, we have reasons to have elevated prices. I don't know if we really do have reasons to go up and make new highs in the wheat unless we really start to see the export demand come to us. But the USDA so far has said we'll believe it when we see it, and so far we haven't seen it. Export sales have really been very poor for wheat, more of a reflection of higher prices killing off demand rather than geopolitical issues causing more demand. So that's a bit of a concern. And then as far as Friday, yes, spring wheat was higher, lending some strength over to Kansas City, but also had some spread action going on. A lot of people have been using wheat as the short end of the stick, long corn, long soybeans. Obviously, you had some unwinding of those spreads there on Friday, and wheat had been down most of the week while row crops had found some strength. So a little bit of stabilization. I mean, the December Chicago or July Chicago was only down a penny and a quarter, but it still was down on the day. So no, not any profound strength there in the wheat, but a little bit of a stabilization. And again, some help from some spreads. Certainly the weather is a concern. But again, we are at some very elevated prices that become increasingly more difficult to justify over time unless we do really start to see our exports pick up, which we have not seen signs of yet.
Well, Ted, let's flip over to the livestock market. And cattle today, we're trading a bit lower ahead of the cattle on feed report. Just got those numbers out here at 2 o'clock. U.S. cattle on feed up 2% from last year. Looking at placements, slightly below 2021. Marketings of fed cattle, 2% below 2021. So just briefly getting those numbers in front of you here real quick. What's your thoughts on that and what we could see with the cattle market maybe moving into next week?
Yeah, everybody was expecting a rather bullish report there. First of all, on Friday we sold off in front of a cattle on feed report, which is duh. I mean, we
Mhm.
we had strength Tuesday, Wednesday, Thursday, and part of that was driven by cash. But whenever we have strength earlier in the week in front of a cattle on feed report, it just seems inevitable that we're going to see some profit taking before the report comes out. Um, that being said, some of the strength that we had earlier in the week was coming from higher cash, but also the expectations for a really rather bullish cattle on feed report. I don't think it was the report that some people were expecting. I'm a little worried that we might find a little bit of pressure early next week, just because the expectations were really so very bullish. And honestly, the marketing's number for me was a bit of a surprise. I kind of thought that number would be quite a bit stronger. Um, so, all the expectations for strength out in August into December, I still think that is really going to be the case. I really do feel like the domestic demand for pork and or for beef and also pork is going to be really strong for this grilling season. I just feel like there's just a ton of pent up demand. We started to see a taste of it as we ventured out a little bit last summer, but this one is the first one in earnest where we're going to be pretty much back to business as usual, and everybody wants to get out and be about. And I think we're going to eat a lot of steaks and a lot of pork chops, Jesse. So I think domestic demand is going to surprise some. I still think that if you want to be bullish cattle, the best place to be is August and beyond. Um, and I don't think we're past the inflationary time frame. I think that is going to be hot and heavy into the first half of summer. Once we get into fall in September, and this doesn't just go for the livestock. This is grains. This is crude oil. This is everything. You really worry about when this inflationary bubble bursts, not necessarily if, because we know that inflationary bubbles burst, go back to 2008, 2009. We know what happens when that happens. Even under unchanged bullish fundamentals in an individual commodity, you can still have a very significant drop in price as we take that inflationary component of the pricing away. Uh, so that is a concern of mine, but that's a concern of mine that happens later in the calendar year. I think before that happens, we're going to have this quote unquote summer of love where we're out just doing whatever we can, spending whatever we have to make that happen, to facilitate these good times that we're sort of desperate to have happen again.
Mhm.
So yeah, no, I think there's a lot of upside potential. But again, I really like the August contract, and the December contract in the cattle is kind of more where I'm leaning.
Hog market too, just coupled with that real quick, really strong on Friday in the
Yeah.
front months, plenty of triple digit strength. Cold storage report out as well this afternoon. Frozen pork supplies up 2% from the previous month, up 8% from last year. I know some folks are maybe wanting to know what that was with this hog market, but really this hog market, just strong numbers here to end the week. And
Mhm.
do you think hogs are overvalued here at these numbers, Ted?
No, I think hogs are pretty right valued, which if you look at the chart, the chart feels that way too. The market feels that way too. Um, so you go to the cold storage report. Certainly not surprising that we have more in storage this year. I mean, look at our exports. We were exporting a ton of pork to China last year because we were filling the gap left by ASF. Now that they've replaced their herd, we don't have to do that, so it's a different year, right? And it's hard to compare year over year like that when you have something like that was very different than most years with all, again, the issues, the ASF issues in China. That being said, you kind of offset that a little bit with my idea that I think we're going to have some very, very strong domestic demand. And ultimately, I do think we can try to go higher for the reasons why we talked about, again, domestic demand, inflationary pressure, upward inflationary pressure at first. Later on, I get worried about that. But right now, again, you have a chart that is sort of a descending triangle, meaning we are closing the range ever tighter and tighter and tighter. We were lower earlier in the week, had a very nice bounce once we hit support there on Friday. We're right back in the middle of that and sort of getting towards the tipping point where we see a breakout one way or another. Um, I lean towards higher in the near to midterm, but again, for everything, I worry about what's going to happen at the end of this calendar year, and that doesn't have really much to do with the individual fundamentals of hogs or cattle or corn or soybeans or wheat. That has more to do with the over macroeconomic climate that we may find ourselves in at the end of the year. And by the way, I think if something like if we get this, or maybe when we get this inflationary bubble burst, August is about the first time that I see that possible. It might take until fall or early winter, but I really do feel like there's a very good chance that by the time we get into the winter months, we will have we will be talking about a very, very different narrative when it comes to inflation and super high price commodities and things like that.
Well, Ted, great stuff. Covered a lot here today. Before we run out of time, any other final thoughts for us on this Friday?
Just kind of going along with that theme, you feel like crude oil is sort of the canary in the coal mine there, as it was in 2008. And you've got a crude oil market that is really reluctant to make a big move. in either direction. Now, as I said, summer of love, a lot of demand. I do think we've got one more big push to the upside in crude oil. I do think we'll go test those highs, probably make new ones, but that might be the last hurrah, right? So as far as energy's costs are concerned and how that's impacting demand for beef and livestock, but also what it means for input costs and things like that, I think it gets worse before it gets better, but I also do think it will get better. There are things that can extend this inflationary period further out in time, but at the moment, I don't see those things happening. So, like I said, for right now, for the next few months, I think the commodity markets are going to be happening. But at some point here, Jesse, you got to go back to 2008 and study a chart because that will happen again. I really feel like that will.
Well, Ted, if folks need a little advice with their marketing, need some help, I know they can reach out to you and the team there at Zaner Ag Hedge very easily. How can they do that?
Yeah, I mean, you can reach me directly. My phone rings. I turn it off when we're doing things like this, but my phone rings directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner, that's zaner.com. You can read a bit about us. You can also sign up for our Ag Hedge newsletter, which is a newsletter, not a subscription and not an advisory letter. We do the advising once we get to know the individuals that we're working with, their operations or their risk tolerances, things like that. And if you're on Twitter, I'm at the Ted Spread. That's sort of the lighter side of Ted. I do some market commentary on there as well, but I also talk about some more silly things, hot dog sandwiches, cars. I'm a big fan of cars and watches and ethanol, really. So yeah.
Yeah. Well, and I'm a little mad at myself. Normally, I put your Twitter handle in the video scroll, and I didn't do that today. And I
That's
realized
okay.
it right before you said that. So it's a
No worries,
Friday.
Jeff.
I'm gonna chalk it up to a Friday.
Yep,
So
we'll give you a break, buddy. Give you a break. Have a great weekend, man.
yeah, you too. Follow him on Twitter at the Ted Spread. That's Ted Seifried with Zaner Ag Hedge. That's gonna do it for the show on this Friday, April 22nd. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.